millions of Americans are being hit with billions of dollars in penalties. In fact, it's $7 billion in 2023, and you might be at risk, especially if you are retired or nearing retirement and you have investment income or you do a Roth conversion. In this video, we're going to explain why these penalties have skyrocketed since 2019. We're going to explain why even people who are doing everything right are subject to this penalty, and we're going to tell you how you can avoid it. But first, my name's Kevin Lum. I'm a certified financial planner, and this channel is dedicated to helping 1 million people retire without worry. For most of us, we know their taxes are due on April 15th and that our employer has been sending in money for us throughout the year that we set with our withholdings. And often we are pleasantly surprised to find out that we get a bit of a rebate because we overpaid our taxes to the IRS. But when we retire, there's no longer an employer to send all of our taxes in for us. And this is especially true if you're doing Roth conversions and you are paying for that conversion outside of the qualified account. You probably aren't paying quite enough in taxes. Normally, these taxes are paid through an estimated quarterly filing. If you don't pay 90% and aren't protected by the safe harbor rules, and I'll talk more about that in a minute, you can owe a penalty, which is the interest the IRS charges on the underpayment. And the rate is set and published quarterly. Currently, it's around 8%. And here's why the penalties have skyrocketed. The amount of the penalty being paid for underpayment in 2019 was around $2 billion a year. Now it's closer to $7 to $8 billion. And part of that is because there's been an increase in the interest being paid because the interest is the prime rate plus 3%. So when the prime rate was basically zero, the penalty was only about 3%. Now the penalty is 8%, and that penalty can really begin to add up. And this is why more people are at risk of this underpayment penalty. It's always been around, but now with the increased interest rates, it can be a significant amount of money. Most people who are retired or who run their own business at some point will figure out that they need to make their estimated quarterly tax payment. But here's the twist. Even people who are making those estimated quarterly tax payments, and the best way they know how, are finding themselves hit with a penalty from the IRS. And part of that reason is because people misunderstand the safe harbor rules. The safe harbor rule works this way. If you earn under $150,000 and you pay 100% of the prior year's tax bill by January 15th or the end of the year, even if you underpaid, there won't be any penalties. If you owed $15,000 in taxes last year, and by the end of the year, you've paid $15,000 in taxes, even if you have an underpayment, there's a safe harbor provision and you don't need to worry about any of the estimated tax penalties. But if you earn over $150,000, you have to pay 110% of the prior year's tax bill to qualify for the safe harbor provision. But here's where things go off the rails. These safe harbors apply per quarter, not per year. And a lot of people, even some tax preparers, don't understand this. So if someone has income in the second quarter, but doesn't pay the safe harbor amount until the third or the fourth quarter, then underpayment penalties could apply. And this is especially important to investors or people doing Roth conversions. Why is that? Well, the IRS has a giant computer system, and the giant computer system treats all income as though it was earned equally throughout the year. So let me give you an example. Let's say you do a Roth conversion in November of the year. So in the fourth quarter, you figure out what your estimated quarterly tax payment should be, you submit it on the IRS website, you're feeling really good about yourself. You go about your life. Then a few months later, you go out to your mailbox and there is a letter from the IRS. Now, if you were like me, anytime you see a letter from the IRS, no matter how above board you are, when you see a letter from the IRS, you immediately assume, at least I immediately assume, I apparently made some huge error and the IRS is coming for me. So you're going to go out to your mailbox and there will be the dreaded letter from the IRS. You're going to open it. You're going to see you're being penalized for underpayment. And you're going to wonder, what in the world did I do wrong? Here's where you went wrong. So let's assume you did a Roth conversion for $120,000. Well, the IRS has a giant computer and it can't differentiate between when you received that income or when you made that conversion. It's going to assume that you made $10,000 in January and $10,000 in February and $10,000 in March and throughout the rest of the year, but that you did not make a quarterly tax payment until the fourth quarter. So it's going to levy an underpayment penalty on you for the first quarter and the second quarter and the third quarter because the big dumb IRS computer has no idea when you actually earned that income. But there's some good news. There's a fairly easy fix. There are two forms that you need to file, Form 2210 and Schedule AI, which tells the IRS in what quarter the income is earned and when the taxes were made. So it's going to tell the IRS, I made a $120,000 Roth conversion in November, and I paid my quarterly taxes in the fourth quarter. This, by the way, is why we always give our clients a tax letter, one for the client and one that they can give to their CPA or their tax preparer that tells exactly what we did on their account during the prior year to enable the tax preparer to accurately reflect when those conversions were done, even if they've already made the quarterly tax payment. But I want to pause here and I want to talk to DIY tax filers who have uneven income. You need to check to make sure your tax software can handle both forms because some programs cannot. So you want to make sure whatever software you're using, whether it be TurboTax or TaxAct or a million other softwares that are out there, that it can handle Form 2210 and Schedule AI. Now, some of you watching, this is not just a hypothetical video. You have a letter sitting in your office right now with a penalty from the IRS. Well, there's still hope. The IRS is typically fairly lenient. Now, I know that's not the impression that people have, but the first time you make a mistake, the IRS is pretty forgiving. And so if you have recently retired and you're at least age 62, or you became disabled, or you're able to show reasonable cause, and they typically have a fairly broad definition of what reasonable cause encompasses. So what you're going to do if you've been assessed this penalty is you're going to file an abbreviated Form 2210 and just follow the form's instructions, or have your tax preparer or your CPA fill that form out. As long as this is the first time you've been hit with underpayment penalties, most likely the IRS, out of the goodness of their heart, is going to waive those penalties. I'd be interested to know if any of you watching have been hit with these penalties. Just leave a note in the comment below. Now, not everyone needs to worry about this, and not every retiree needs to worry about this, because many people have income that already qualifies for withholding. So you have pension income, or you have Social Security income, or maybe you have withdrawals, distributions from your traditional IRA or your 401k, and you chose withholdings on those distributions. If that's you, then it's going to make your life a little bit easier because that income has a special benefit. The law considers withholdings on that income to come in evenly throughout the year, no matter when it was actually paid. So for example, let's say you owe $19,000 in tax for a Roth conversion in the first quarter, and then you withhold an extra $19,000 on an IRA withdrawal in December of that year. That could allow you to avoid that estimated tax penalty on that first quarter income. And most custodians, or at least the two custodians that we primarily use, Fidelity and Schwab, allow you to adjust the withholdings. And so you can increase the withholdings on that IRA distribution later in the year to make sure that it covers the Roth conversions you've done throughout the year, so you don't have to worry about those underpayment penalties. Now, also, states have their own underpayment penalties, but that is way outside the scope of this video. I could be here all night trying to go through every state's rules around underpayment penalties, but you might want to check in with your tax preparer or CPA to make sure you are set for your own state. This is also why it starts to become even more important to have a financial advisor as you move into retirement, because there are just a ton of little things like this that can catch us by surprise. And you want to make sure that financial advisor specializes in retirement planning, because a lot of advisors are not aware of this nuance. Now, there are a ton of different ways you can work with an advisor. You can have them manage your assets, or you can just pay them hourly or a one-time fee. There are lots of options out there, but I would recommend having someone help guide you through these trickier questions. And if you're wondering how to reduce taxes in retirement, because that is becoming a larger and larger issue, I have a playlist with a few of the videos where I talk about how you can reduce your taxes on your Social Security using the correct withdrawal sequence and also Roth conversions. And I put that together and you can watch that now.